And my next guest warns that the recent rise in mortgage rates will test the resiliency of all those new home sales. And he's forecasting fewer than 5 million total homes will be sold this year. That's the fewest in 12 years. Joining us now is Duncan, Fannie Mae's chief economist. And we are also pleased to be joined by real estate pro Don Peebles, chair and CEO of the Peebles Corp, to weigh in on all of this. So welcome to you both. Doug, I'll just start with you. And I think it's important, especially for investors who've been so focused on the strength of the home builder index, to understand that the housing market broadly is still, well, how would you describe it? Quite slow.
Yeah, it's a tough market. If you're a realtor or a mortgage lender, you're feeling like this is a serious recession. If you think about it, we went from about 6 million homes at an annual pace down to about a little over 4 million homes at an annual pace. That's roughly a third drop in the business in your industry. So when you put on top of that the disappearance of the refinance business, it's feeling really rough for the mortgage space.
Right. And I guess sort of on to that point is the question about whether the strength we've seen in the pockets of home building and for the stocks that we've been following can continue, because as rates go higher, you're saying it's all the more important they continue to do buy downs or something to make this more affordable.
Yeah, what's unusual in this environment is typically housing is, if not the most interest rate sensitive, one of the most interest rate sensitive sectors. So when the Fed starts raising rates, typically construction starts to slow. That's the first part of the cycle. And then that's followed by sales on the way down. In this environment, because the boomers are doing what they said they were going to do and aging in place, and because the Gen Xers have locked in 3% mortgages, it's really all on the back of the builders to increase supply. So this has been a pretty good market for them, surprisingly, even though the rates have been rising. Demographics are in their favor, and the slow supply suggests it's going to be the builders that are going to be adding to supply and trying to eventually equaling things out between buyers and sellers.
And so, Don, if I may put it like this, would you still be bullish on the home builders, and, you know, in spite of or because of everything that we've seen? And what do you think happens with residential real estate at this point?
Yeah, I think that the future is still positive for home builders. What's happened is the overall fundamental of real estate, the very simplistic fundamental of supply and demand, is holding strong. Anyone who wanted to buy a home or refinance pretty much had done it by the time interest rates had moved up. And so you have to have new buyers coming in, people who are going to trade up or not trading up anymore because they've got lower interest rates. But income's going up, and interest rates are going to stabilize. You'll see them pull back next year a little bit, and there'll be a shortage of inventory because most people who have an interest rate of 2.5%, 3.5% are not going to sell their home because there's a lot of value in that low rate interest rate.
Are you bullish on multifamily? That's the one area when we spoke to Willie Walker yesterday where he said, you know, and we've heard this from banks and different people, but we also know there's an apartment glut in a lot of the country that's potentially forming. So is that an area that's attractive to you on the development side or no?
Well, I think it depends on where. If it's New York City is still supply constrained. There's a significant demand for housing, both workforce, affordable, and market rate upscale housing. What's going to hurt the apartment building sector is interest rates, especially on existing assets that have been purchased based on prior interest rates and have been bought at 3.5%, 4% cap rates.
Right.
Those are going to have a significant amount of stress as the interest rate swaps burn off, and they have to pay real interest rates. And I think, and there's nobody to refinance with right now. And I think that's a big issue.
And if they can't raise rents because of the other supply or the other factors going on here. Doug, let me ask you as well about one thing that's creeping into the market. We spoke with a company called Rome, ROAM, that's trying to kind of match people to assumable mortgages. In other words, you know, saying for some of these properties, and this applies more to FHA and those kinds of pockets of loans, that when you buy the property, you could potentially assume the lower mortgage rate that comes with it as well. Could something like this ever go more mainstreamed, you know, across mortgages and existing homes of almost all types?
Well, they could, but it's difficult when rates change by a significant amount in a short time period, because, of course, you need to make the mortgage holder whole, given the change in market rates. So while it's been out there for a very long time, particularly in the FHA category, you haven't seen a lot of action in that space simply because the rate rise was so significant and so sudden.
So in other words, in order to make them whole, that means what?
That means that if they have the existing mortgage is 3% and the market rate is 6%, you're going to have to make up some differential for that the value for that seller.